All right, guys, welcome back to the Independent Investor Channel. My name is Ryan. We're trying to provide as much benefit as we can and insight on how I seek out my investment opportunity. Now, the way that I seek out my opportunity doesn't mean it's going to be a perfect fit for you. That's not the point of putting out this information and discussing how each and every one of us seek out our exposure to the market in some form or fashion. But I think you guys can benefit by understanding what strategy I place on each one of my accounts. I hold north of 10 accounts. All right, and in this video, I'm going to highlight some of the strategies that I deploy in each one. There's a reason why I do each and everything that I do with the account before I open it, okay? And in this video, we're going to kind of walk through my thoughts on what strategic contribution this makes to the total overall portfolio. And without one, the others suffer. It's amazing in finance how each of these strategies, when they're overlapped with each other, can really work in harmony and help contribute while this is doing its strategic goal. It can help contribute to and amplify what you're trying to do over here, okay? So I'm going to run through these strategies fairly quick. I'm going to throw them out there, and if I strike a chord with you, and maybe you guys are initiating some of these strategies for yourself as well, wonderful. If I've identified some of the strategies that I deploy that maybe you're not using, maybe think about deploying this or initiating some of these strategies in your own program. You might be glad that you did. The first that's worth mentioning, that's probably the most appropriate for everybody out there, is the employer-sponsored retirement plan or program, okay? Roth IRA, or excuse me, the Roth 401k program, 401k, 403b, 457 accounts. There's a ton of different options out there, and usually you're corralled with your opportunities with that. The way I seek out my opportunity or my strategy is from a passive perspective. I contribute as much as I can to give me the opportunity to fund in other areas of my portfolio, okay? So I established this. It is a tax-protected account in my particular program. But what it allows me to do by contributing to that is it affects the way I think about deploying capital in my other opportunities. What I mean by that is if I can establish a nice, safe, diversified, passive base in my employer-sponsored retirement account, then it allows me to deploy other strategies. It allows me to not have to duplicate or overlap the strategies because I've already covered that base in my thrift savings plan. And a lot of you guys are doing the exact same thing with your 401k. So the takeaway here is if you're deploying a strategy in a 401k, maybe you're taking advantage of a matching, that of which I don't have that option. I really wish I did. So for you guys that have that option that can do that matching contribution in your 401k, lovely. Do it up to the point where you're taking that maximum match and then look to maybe deploy some of that surplus capital elsewhere, maybe in the option that I'm going to mention next. And then it can kind of drive your decisions. If you already have some existing assets within that 401k, maybe it can help drive the decision making in the follow-on layer to your total comprehensive plan that you've got. So the employer-sponsored, that's number one, and that applies to most people out there. And that's really the majority of the people that I talk to, that might be all that they have, okay? But I contend that there's probably people out there who could definitely benefit from layering up on their program, okay? So that's number one. Number two is the individual accounts, okay? Whether or not a traditional or a Roth is appropriate for you. Definitely if you're a high income earner, this might be the time where you just might want to go ahead and add that taxable brokerage account. That way you can overfund it. You can contribute as much as you want to it. That's one of the detriments to the individual accounts is that you are capped with the annual rates. This year in 2020, it's going to be another $6,000. So if you are subject to those annual caps and you are eligible to contribute to an individual retirement account, I encourage you to look at the prospects of doing so, because again, when the 401k is working over here, you can maybe consider layering up a little bit for either you as a single person or your spouse, okay? So you basically double the benefit. So it's not now $6,000, it's now doubled to $12,000. Now, if you can comfortably fund every year and put $12,000 away, good on you, okay? You can still open the taxable brokerage account on top of that, okay? But for a lot of people, you've got now the 401k, now you've got the individual Roth accounts, whether it be traditional or a Roth, and some may not need to go that extra taxable option, okay? But for me, I am in the camp, I do have one for myself and my spouse. The strategic goal in each of those accounts is a little bit different. Because I am restricted in the options that I have within my employer-sponsored account, I use the individual self-directed accounts in a couple of different very, very specific goals. Number one, I get to pick what I want, how I want, and when I want. That's a beautiful luxury, not to be overblown, okay? You guys know I seek passive, diversified exposure up to about 25% of the value in each of the two accounts, okay? So that creates kind of a fundamental base. It allows me that exposure to the S&P 500. It allows me some specific exposure to the utility sector and the real estate sector in some specialty ETFs. It gives me the opportunity to invest in foreign dividend opportunities. It gives me the opportunity to invest in some dividend appreciation ETFs. And it also gives me some opportunity for developed markets, Europe, and finally emerging markets. Okay, so those are the freedoms that I don't enjoy in the employer sponsor, as I've only got 5 options to choose from and what allocation I want to mix the money up into. In my self-directed account, I can do what I want, how I want, and when I want. Okay, so that 25% represents the first tier layer within those individual accounts. The second tier layer is probably the most important aspect of my asset bucket. And the rest of the 75% in each of those accounts are comprised of blue chip, dividend paying companies. And that is the dividend growth aspect of both of those portfolios. The idea there is that we've set those great companies up to appreciate and accumulate over time. As they pay dividends, they are organically growing within that account. It is a no-fee opportunity within each of those opportunities now, because investing in single stock has gone to zero. So there's zero upfront fee anymore to enter into these great blue chip companies that I invest in. I get into specifics on my portfolio review, but this is a strategy video. I really want to outline the highlights and the strategy of each account that I've started, okay? So we've got the employer sponsored, we've got the individual Roth. Next, we're going to go to the joint brokerage account. Within the joint brokerage account, I have this housed outside of the tax protection of the Roth, okay? Those are working. Most of the time, those accounts are fully funded working for me. In the joint brokerage account, I quite simply have a mixture of ETFs that are all fixed income. Okay, I have about 8 in there. It gives me exposure to international debt. It gives me exposure to short-term corporate debt. It gives me exposure to short-term treasuries, and it gives me exposure to medium-term debt and treasuries and long-term debt, both U.S. treasuries and corporate debt. So that is my fixed income aspect of the portfolio. Strategic goal is very, very simple. Those assets organically grow in and of themselves. They're very low cost of entry. They are able to pay dividends. And when they do, I have those set up on a drip, those dollar cost or dividend reinvest back into the underlying portfolio. And it's a sleepy aspect of the portfolio. It basically funds itself and it organically grows over time to get me that counterbalance Right now, it's about 11 or 12% of the total overall assets in the portfolio. And I love owning them. I really do. At 42 years old, it makes sense for me to have a small section of the portfolio that is devoted to fixed income. And I've loved owning them. I really have. It's amazing how when the stock market gets volatile, those fixed income assets will really perform nicely, and it creates a nice counterbalance in that. So I own those outside the Roth because I don't want to put that money to sleep within the Roth. I would like to give the best opportunity within the tax shelter of the retirement accounts, the best opportunity to grow. And I think with fixed income, getting 4 or 5% a year, I'm satisfied with that. We're outpacing inflation a little bit. That's one of the goals, to having some of that money put away and also to be a counterbalance to the volatility in equities, okay? The next I'm going to talk about are my taxable accounts, okay? I have 2 with M1 Finance. The strategic goal on number 1 is to get me sector exposure. You guys know in my SPDR portfolio, it's comprised of all 11 sectors, made possible by the Vanguard Specialty ETF section, okay? If you're interested in finding out more information about this Vanguard product, it gives you exposure to each of the sectors itself, okay? So large cap, medium cap, and small cap within, for example, technology, or within industrials. So I've broken it down and I've bought all 11 sectors within M1 Finance. Why did I do that? The strategic goal there was diversification, number 1. Number 2 was to leverage the great opportunity within M1 Finance to portfolio redistribute not only the dividends, but the contributions as they go in there. And that portfolio has done quite well. We are well over 15%, approaching 16%. Started it March of 2019, so it's performed nicely. Less than a year, haven't even owned it for about 9 months now, I guess. And looking to really get that diversified exposure over that portfolio, but grow it organically. Have a nice diversified portfolio over the entire stock market, covers all the sectors. When I have underperforming sectors, that's lovely because the fundings roll back into those underperforming sectors. If some sectors take off and they perform well, then we will benefit from that capital appreciation within that account, okay? The other M1 Finance account is a completely different strategic goal that I deploy. That houses 12 of the most aggressive companies that I want exposure to. We are talking about Alibaba, Amazon, Google, Facebook, Adobe Systems, PayPal, NVIDIA, Netflix. So we're talking about, I think I've got Uber in there, Tesla, and a couple other names. There's 12 total. To get the details of that, you're going to have to tune into the portfolio that I review, and I share those portfolios with you guys openly. If you're interested in just using the link, you'll get to see what I actually have in there. But the strategy that covers that particular aspect of exposure in that is aggressive growth, okay? Now, I'm using the M1 Finance opportunity to leverage the opportunity in partial shares. You'll notice that I only have about $5,000 devoted to this portfolio. Relative to the total overall portfolio value, it's relatively small, and that's fine. These high aggressive growth companies are very volatile. They can move up and down on a whim, and I thought the best way to strategically invest in a company like an Amazon, like a Tesla, that has really violent price swings is to take advantage of the partial shares that are available only through M1 Finance. So you guys notice how I did the portfolio redistribution on the first M1 Finance account. On this one, I'm leveraging the opportunity made possible only through M1 Finance for the partial share purchase program. And it's a wonderful, amazing thing to be able to enter into a half of share of Amazon, and it's not going to take a large chunk of the portfolio, okay? I can invest a few $100s, in this case $600 or so, in a company like Amazon, and it gives me a lot of surplus capital to basically spread across that aggressive growth portfolio. So you guys can kind of get a theme here. to where each of these portfolios that I have set up really have their own personality. And that is the strategy that I hope that comes through on this video, that you can really pick up on in understanding that I have a theme. I have a strategic application for each of these little accounts that I have. Some of those strategies are only made possible by the unique nature of the broker that I choose to deploy that strategy. Very, very important takeaway to this video, all right? And I will just quickly mention the first trade account. Obviously, that's where I take some of the revenue that I generate through some of the online business opportunities, eBay, some of those things, and that goes to fund the first trade opportunity. It is a taxable account. It is passive in nature. I've just recalibrated that account a little bit, so you're gonna have to stand by on that portfolio review, how you can see how I've condensed that a little bit more passively in nature. I've got some S&P 500 exposure there. I've got some high dividend yielding exposure and some small cap exposure. So really wanted to make sure that we were set up long term on that to dollar cost average, to stay diversified and make sure that we were getting the best bang for our buck and exposing our dollars to the potential for dividend income going forward. And I'll just finally offer this. My checking and savings account also have a very strategic goal in this total comprehensive portfolio. I've covered most of the invested assets, whether it be tax protected or in a taxable account. My savings account is really my hedge and my buffer. That right there is my sleep easy money. It's my emergency fund. It does not outpace inflation, but it allows me to sleep easy. Okay, I keep that completely separate from my investing portfolio that I just disclosed to you. Okay, that gives me the opportunity to take advantage of downturns in small strategic application if I want to, small strategic amounts. If the market adjusts back 10% or 20%, I always have that surplus capital there to put to work. I always have it in case I have an unexpected expenditure come up in my life. So think about the strategies that you want. When you start something as simple as a savings account, guys, it's super important to understand not only just why you start the account or to start the account just to start it, but understand what goal you want out of the account and demand that strategic goal is met for that. Checking account, same idea. The checking account really serves as my sacrificial lamb, for a lack of better terms. That is the account where the inflows come in and the outflows go out. Everything is linked to the bills in that. Now, some of them are manual because I think it's a lot easier. I think you can get a little bit overblown with setting up everything on auto draft. Especially for accounts that have the potential to change over time, utilities, rents, etc. Within the bill pay function of Bank of America, it makes it super easy to go establish that account. And instead of setting it up on auto pay, we just go in there and it takes us less than 5 minutes to put the amount in there and fire the bill away, and it's done. It's off. The budget is done. Usually we can spend the paycheck in about 5 or 10 minutes. It's all done. It's all the money is allocated, and that's what I use the checking account for, is basically the inflow and then boom, the outflow to make sure that I'm paying myself every single month, month in and month out. Guys, I hope you enjoyed the strategic look on the majority of my accounts that I hold. You'll see that each one of the accounts have their own personality, okay? Now, this has been built up over many, many years of wealth building, okay? But this is the mindset that I really want you guys to start to adopt, is you can do it. Anybody can do it. It is all a mindset. It has nothing to do with how capable you are. It has nothing to do with being the sharpest person in the room. It has everything to do with just a very simple desire to do it, okay? Now, the majority of the strategies that I talked about are spread across a lot of different accounts, and you're not going to be able to do it overnight, okay? Start one. Start one. If you have that employer-sponsored 401k out there and you have the opportunity to maybe layer up and start that additional individual account, then we've struck a nerve in this particular video and understanding the different strategies that I deploy in my personal program. Guys, hit the subscribe button, leave your comments at the bottom of the video here, share the message with anybody out there that you think could benefit from the information that we're putting through on the message. Thank you so much for tuning into the video, and good luck in your investment future.